Welcome everyone. So this evening we're going to cover task 3 and task 4. So task 3 is about investments and property. It's not one where they get particularly creative, shall we say, and it's worth 10 marks. Remember, it's a 2-hour exam, so it's 1.2 minutes per mark. So in theory, we should have 12 minutes to do this, which isn't too bad. But if we go off down a few rabbit holes, it doesn't matter. We've got an hour this evening. So the points to remember here: never, ever, ever put an ISA in a tax comp. They will give you that, both in this task and the next one. Watch out for that. And then you've got national savings and investments. Which out of accounts and certificates is exempt? Anyone? That's right. National savings and investment certificates are exempt because there's an E in certificates, there isn't in accounts. Really, that's a particularly poor way that I remember which way it rounded is. And thing to watch out for is the allowances, savings allowance and dividend allowance. So dividend, everyone gets £2,000, and the savings allowance just depends on your level of income. But one thing I do want to stress: it is not like the personal allowance where it's an exempt amount. It is taxed. It is just taxed at a rate of 0%, and we're going to see that in action later on. And then we've got property income. Just remember that your rental income is on a rising basis unless your property income is over £150,000, which it won't be because that is crazy amounts of property income. So when you do your tax comps, as you'll see, on property income computations, we'll do it on a rising basis. And then watch out for replacement furniture relief. And what's the other thing that they may bring up in a property type question that they will not prompt you to use? That's right, Lucy, the £1,000 property allowance. So this is £1,000 you can use against your property income. So if your property income is less than £1,000, it's free. Or if your expenses are less than £1,000, use the property allowance instead. It will not say you must use the property allowance. You'll need to know when it is appropriate and when it's not to use it, which is when your expenses are less than £1,000, because that's better for you than using expenses, but you cannot have both. Cool. Right, let's look at some questions then before we carry talking. So Michael receives interest in an ISA of £7,400 and interest from his building society account of £1,270. His other taxable non-savings income, so it's taxable, so that's after the deduction of the personal allowance, so don't do it again, is £37,200. He has no other sources of income. So this next bit here is what I really want to stress. So it has asked what from his investments, or how much of his investments will tax be paid. So how much of his investments will he pay tax on? So firstly, we're going to ignore the ISA because that's just exempt. But remember how I said the savings allowance is taxable income. It is just taxed at 0%. We haven't been asked for taxable income. We've been asked for income on which he will pay tax. So that doesn't include the savings allowance. Does everyone see how that differentiation in that wording? So if you'd asked for your taxable investment income, it would be all of this. However, he doesn't ask that. He wants to know on how much of his investments will he pay tax. So we'll need to deduct off the savings allowance. Now, how much of a savings allowance is Michael going to get? Yeah, you are right. So he has £37,000 of non-savings. So that's going to use up all, but we take off there 37,700 is the basic band. Take off the 37,200 that will be used for his non-savings means there's £500 of his basic rate band left. Therefore, the 1,270 takes him into the higher rate band. And because he's a higher rate taxpayer, he will get a savings allowance, which is also £500. So that's our savings allowance. So of the 1,270, we take off the 500, so that's going to give us 770 pounds of his investment, which is going to be taxable. Does everyone see where that 770 came from? So it's that we've worked out what his level of income is. He's now into the high rate band. He's a high rate taxpayer. Remember, these given you the reference deal. So he's got a £500 savings allowance. Take that off the 1,270 means there is now £770 of income that is not covered by the savings allowance, and therefore he will pay tax on it. So what rate of tax will he pay? That's right. So this is going to be taxed at a rate of 40%, because all this now falls into the high rate band. So that £500 savings allowance used the last £500 of the basic rate band. So we didn't take £500 off and then put it all, well, put £500 into the basic rate and then the remaining 270 into the higher rate. It all fell in the higher rate because of the income covered by the savings allowance still using the basic rate band. So £770 all at 40% gives a figure of £308. Everyone happy where that came from? Cool. Right, that's that one done. Now, Sally receives dividends of £22,000. Her other taxable income totaled a whopping £156,900. Again, that is taxable. That is after the personal allowance. I'll just finish this one off, Sheila, and I'll quickly recap that. So, dividends. How much of a dividend allowance is she going to get given her level of income? That's right. Level of income is irrelevant. Everyone gets £2,000. So of her dividend income, we're going to take off £2,000. Gives us 2,000, means we have 20,000 of her dividend income is going to pay, or she's going to pay tax on. So her £22,000 of dividend income is taxable, but only £20,000 of it will she pay tax on it, because the first two is covered by the dividend allowance. And given that she has got income of taxable income, I should say, or £156,900, what rate of tax will she be paying this on? That's right. So this is the additional higher rate for dividends. So savings and non-savings are pretty similar, but dividends are these strange ones. So the higher rate, additional higher rate for dividends is 38.1%. Don't ask me why. And it's changed this year as well. So £20,000 times 0.381 gives a figure of £7,620. Cool. Right, I'll just quickly recap the first one. We had a basic band of 37,700. We used 37,200 of that on our non-savings, meaning that there was £500 of her basic rate band left. Now that just happened to be the same figure as what was covered by the savings allowance, which was £500 because she's a high rate taxpayer. That means the excess that's not covered by the savings allowance, £770, all falls into the high rate band, which is taxed at 40%, giving us that. Cool. Right, next one. Leroy, what's we've got here? He receives interest bills side account of £15,000. All his other other taxable non-savings, a whopping £189,000. He has no other source of income. Cool. So we need to calculate the total tax payable on this interest. So what sort of savings allowance are we going to get? That's right. Because they are a quite clearly additional higher rate taxpayer with this crazy amount of savings, that means that they're going to get no savings allowance. So the full £15,000 of this is taxable. And you see where I'm going with this? At what rate are we going to tax this? That's right. Like I say, all these are given to you reference to, but promise, when you've done quite a few questions, they will start to come to you without to look them up. So it's going to be £15,000 times by 0.45, so 45%. Give you £6,750. So the key takeaway I want to get stressed from this question is no difference between taxable income and income on which tax will be paid. They're very, very keen on these types of questions. Any questions on that before we look at something completely different? Right, I will take that as a no shouting or anything. So Svetlana, so moving on to property income, has a furnished house which she lets out at £800 per calendar month. In March 22, she raised the rent to £880, and the rent is paid on the first day of the month. So for our tax year 21-22, on the move again, how many months will their tenant be paying £880 rather than the two 800? Anyone for anything else other than 2? So it goes up in March. Well, the answer to this is there would actually be 2 months. The reason being, it is paid on the first day in each month, and the rent here is clearly nowhere near £150,000. Therefore, this is going to be on a rising basis. So effectively, it doesn't matter to what period the rent relates, it's when do we physically get the money. So if we set up a timeline, our tax year runs from the 6th of April 21 to the 5th of April 22. So we'll ignore the first ones, but at the 1st of March 22, the rent goes up to, that should be an 8, £880. Now, this one here, on the 1st of April 22, we know the vast majority of this does relate to the following tax year. So you've got 5 days that this payment relates to our current tax year, but the rest relates to the following tax year. But it doesn't matter. We received the money within our financial year, therefore it's going to be assessed in our financial year. Does everyone see why we've got 2 payments at 880 and obviously 10 at 800? And then we want 2 at 880. I should be able to do it in my head, but it's late and it's hot. So 880 times by 2 is 1,760. Giving total rental income for the year £9,760. Everyone happy where that came from? Cool. Right, let's get this put into our pro forma before I forget. 9,760, wasn't it? Cool. And then it's a case of going through here and what can we have? So decorating, yeah, that's what we're looking for, is things that maintain the value of the property, not enhance it. So decorating is just maintaining it as it once was. Insurance is fine. Water rates, if we're paying that for our tenants, obviously our rent will probably be a little bit higher because they don't pay the water rates, but then we've got the expense, we allow it. Conservatory. Now, obviously that, you're right, we're not going to allow that because that is enhancement and expenditure. That is of a capital nature. So when we talk about capital gains tax, I haven't looked, it might be Wednesday, probably will be Wednesday. We talk about that would be allowable for capital gains tax, but it's not allowable for income tax. So we're not going to allow that. But what about this replacement washing machine? Yeah, so because it is a replacement, we can allow it under replacement furniture relief. Whereas the TV, exactly right, it's not replacing an old TV. So if we were to replace this TV down the line, it would be allowed, but the first initial purchase of an item isn't going to be allowable. So we've got decorating at 750 insurance, so I can remember. 7 such filled in. 600 water rates were 300. That's not allowable. The washing machine is at 866, and the TV is not. Gives us a total profit for the year of our property business minus 300, 866, 7,244. Everyone happy where that came from? Cool. Now, what would have happened if, for example, what's going on, if this replacement washing machine was actually a replacement washer dryer, which cost £1,000, whereas the replacement washer was 866? Yeah, so it wouldn't be like for like. So we can't claim the full £1,000 for a washer dryer. But what we can do is claim the amount that would have been an equivalent amount. So if we replaced the wash machine with a washer dryer for £1,000, but a equivalent wash machine was 866, we'd be able to claim the 866, even if we didn't pay 866. We'd have to go and find the value of an equivalent one. And then we would, down the line, if we did replace the new washer dryer, we'll claim that down the line. But you can only claim the like for like element. But it doesn't have to be like for like, but you can only claim that amount. Cool. Right, last little bit, let's look at some property losses. So you've got to be very careful with these types of questions. You need to know what relates to what year. So our year is 21-22. That is when we have the loss. So in 2020-21, he has profits of £6,000. So that's the previous year. And then in the following year of 22-23, he's expecting profits of £11,000. He has no other income. Not that that's relevant because you can't offset property losses against other income. But how much of our losses of £14,800 can we use against the profits from 2020-21? Yeah, so he can't use any profits and any losses from 21-22 against 2020-21. Property losses can only go forward in time. You cannot carry them back, which then means how many of these losses can you use in 22-23? Yeah, so it's going to be 11,000 because you can't use more than you have property profits. Because like I say, you can't use a loss of property income against anything else. So you can only use that against property losses in the future. That's what you have to do. Now just watch out for Angela, because you've got this £11,000 is profit. So that would have been after taking into account if it was sensible or relevant to use the property allowance. So that is the actual profit figure rather than rental income. So just watch out for that. So I don't know, there might have been some expenses, there might not, but you can only use property losses against future property profits. That's all you can do with them. Cool. Any questions on task 3 before we move on to the big one? Cool. Right. Take that as a note. Where's my mouse gone? So now we're going to look at, but it is nil because you cannot carry losses back. So that is back in the day. Well, not back in the day, that's the previous year. So those losses can't be carried back to 2021. It can only go forward from 21-22 to 22-23 and then onwards. So this is task 4. We've got 14 marks, so that's about 16 minutes to do this. Now, really annoyingly, this is on a separate page. So there might be a bit of scrolling once we get it, the pro forma put together. You have to do this. So when you come to these tasks, you should just be looking for, you know, the main sort of things you'll see. Extending the basic rate band. Almost sure you're going to have to do that. What else have we got in here? Personal pensions, occupational pensions, they're very, very likely. Extend the basic rate band by the gross and personal pensions and gift aid. And it's not in here at all. The other one that I would also say, that's it, it is here. Reduce the personal allowance. I would think that's, you know, quite likely to come up. And again, that's one that's easily missed. So when you these, obviously, this is one of the biggest tasks in this exam. It's worth 14 marks. You should do loads of practice on this because you go in, you know you're going to have to do this, and you do the same thing time and time again. So look for pre-tax deductions, look for extending the basic rate band, and look for the reduction in the personal allowance. Everything else is pretty much given to you in the reference material. Cool. So let's set up our pro forma. So here we've got 4 columns like you are going to get in your exam. So we all set it up in the same way. Non-savings. E on the end of that. Non-savings, savings, and then the last one is dividends. Don't do it any other way because you will get it wrong. So I can remember we had employment income. Can't remember what it was. So we're going to put that in at 38650. That goes into non-savings. So we've got that. Property income, 20,000. We then dealt with that. So building society, that's going to go in there. And we've got ISA as well. So 1,500. That one's going there. And ISA, we want to put that in there. And we want the examiner to know that we know it's exempt. We've not just missed it. So you can put it in like this, or you can write exempt, as long as the examiner can look at this and go, yes, they've looked at the ISA, they've assessed where it needs to go, and they've decided, or no, that it's exempt. And the last one's dividends of 8,700, which doesn't go on that row, it goes on the next row. So when we add this up, what figure are we going to get? Not as in the figure, but what is the figure that if we add it all up, we're going to get? So it's going to be 58,650, 1,500 and 8,700. So what should I be putting in this box here when we fill in from? Because you will not get a pro forma. You'll not get a pro forma. You'll have to type in everything yourself. So you need to know what these figures are. So this one here, yeah, is your total income. No, that one, it must be the row above. So total income. There, because we want to differentiate that from a different row. So then we do a quick mental check. So we've got total income of non-savings 58 plus 1,500. That's going to be around 60,000. Then plus that's going to be about, well, £69,000. So what are we not going to do because of that? When you've had a quick mental look at what level of total income they're going to have. Yeah, we're not going to work out our net adjusted income figure because we know their income's nowhere near £100,000. So we don't need to work out that. So we can just put in the standard personal allowance of £12,570. So from there, what's the next figure we're going to get when I take the personal allowance off the non-savings? 58650 minus 12570 is a figure of 46080. That's right. So it's really important you label these correctly because you need to show that you know what these figures are, because like we've seen in the previous tax, it will give you taxable income, it may not. So you need to know the different definitions between total income and taxable income, because it will be relevant in other questions as well. So we set that up. So we've been through all that, dealt with all that. So we've got PAYE, and then a gift aid donation of £300. If our income was over £100,000, we'd have to do the adjusted income figure and take £1 off the personal allowance for every £2 that income is over £100,000, which remember that rule's also given to you in the reference material. But I think it's very likely it might come up. So you should be going in there and thinking, I need to check, because it's probably going to happen that you'll need to reduce your personal allowance. Anyway, so we've got PAYE, we know where to deal with that, and that's not. Now, we've also got a gift aid donation of £300. So what does that mean? So it's not give as you earn, because if it was give as you earn, we would have dealt with it as a pre-tax deduction right up at the top under employment income. So you're right, we're going to, because of the gift aid, a bit like a personal pension, we need to extend the basic rate band by the gross amount. So that's going to be 37,700 is the usual one, plus it was £300 times by 100 over 80. Now I just divided by 0.8. So £300 divided by 0.8 gives us 375 plus, no, equals plus 37,700, gives a basic rate band of £38,075. Does everyone follow where that came from? Cool. So we can then put in our basic rate band. Again, you can use acronyms because the person marking it will be an accountant, will know what you're doing. Basic rate band, working one, reference it, 38,075 at 20%. Gives us figure times 0.2 of 7,615. Fine. So we've taxed some of the non-savings now at the basic rate. So the rest, which is 46,080 less the 38,075. And we taxed at 40%. So 46,080 minus the £38,075 that we've already taxed gives us £8,005 of non-savings going to be taxed at the higher rate of 40% times 0.4 gives us a figure of 3,202. Everyone happy with that? Okay to there. Cool. Right, let's move on to savings. So we've worked out their income is going to be nowhere near, well, it's nowhere near £100,000, never £150,000. So they're not going to be an additional rate taxpayer. So they will get a savings allowance of £500, which is taxed, as you say, at 0%, which is obviously zero. So that has taxed the first £500 of her, or him, don't know who it is, of their savings allowance. So the remaining 1,500 minus the 500 is obviously £1,000, is taxed at the higher rate for savings, which is 40%. I don't know why I got a calculator out for that. So that's going to be £400. Cool. Right, get in there now. We're at dividends. What's the first thing we do? Yes. So irrespective of what leveling, everyone gets £2,000 at 0%, which is obviously zero. And that means £6,700 is taxed at the higher rate for dividends, which is what? Yeah, 32.5%. So 6,700 at 32.5% gives us a figure of 2,178. Okay, so we've now taxed all their income. Everyone happy up to there before we take this next step? So I'll double give you a moment. So 16. So this figure here of 13,395 that I've just added up, what figure is that? That's right. So this is their tax liability. That is the total amount of tax they will have paid at the end of the day when everything comes out in the wash. But from that, they have paid 11,782. That should be 11,782 already. So 13,395 less what they've already paid in PAYE. Remember, PAYE is the only tax deduction source nowadays. Minus 11782 gives a figure of 1613, which is what? That's right. So that is tax payable, i.e. what they still owe and have yet to pay. And as long as it's not being collected up in the in your PAYE, sorry, in your tax code, when do they have to pay that by? Not that it's in the question, but it's good knowledge. Yeah, that's right. So if we are on 21-22, so that would be the 31st of January 23. So they get plenty of time for that. But actually, at that sort of level of income, well, you might not. You might just, because it depends also when you do your tax return. Now, this isn't an exam, but if you do your tax return before December and it's below £3,000, you can just collect it in your PAYE coding notice. You have to pay it all out in full. But if they don't do that, that is when they have to submit their tax return and pay their tax. Tax payable. Cool. Right. Last little bit. So we've got a bit more of a human marked element. We've got a written question here, unfortunately, which, yeah, you can get. But the lion's share of any marks are going to be, you will have to write all that out. You will literally be given a grid. There's no like drafting a term of financial statements where you've got a little bit of pro forma. There's none of that. It is a box. So it is good to practice setting it out as you would in the exam with 4 columns and working it out properly. None of this, I'll do it properly on exam day, because you are going to have to do it. Cool. So we've got a written question here. Now, this is probably here because that was a relatively straight, we didn't have to do anything with the adjusted net income. So we've got this to bulk it out a bit. So Julie's thinking of joining an occupational pension scheme and paying £50 a month. Her friends told her, also that person down in the pub, that she'll extend her basic rate band. Well, firstly, can she extend her basic rate band with an occupational pension? Yeah, the answer to that is no, you can't. That only is for, and obviously you write these out in proper senses, but it's only a personal pension where you can extend your basic rate band. And extending basic rate band is only interesting if you are a higher rate taxpayer. So if you earn £25,000 and you put some money into your personal pension, you'll get the 20% tax credit, you'll extend your basic rate band, but it will have no effect on you because all your income is taxed at basic rate anyway. But what will happen with her £50 a month she puts into her occupational pension? Yeah, so it is a pre-tax deduction. So as its name suggests, it is deducted before tax. So in effect, it would be deducted here. And if you do get an occupational pension or give as you earn, we want to see the gross employment income less the bit that you've taken off. Don't just take it off. Because if you make an error in taking it off, we just think you've picked up a wrong employment figure. So we take it off before tax. However, if you get a question like this, and there is a number in there, 99 times out of 100, you're giving it for a reason. I would want probably something a bit more specific than just deducted at source. I mean, you can say it's deducted at source, but you would then want to put the wraparound stuff of deducted at source before tax, and this is what it would do. But if you're given a number in these things, try to use it because it's given there for a reason. So say, for example, they are a basic rate taxpayer. So what's going to be the effect for Julie if she's a basic rate taxpayer of her putting £50 per month into her occupational pension? And we can do the effect per month. So what would be the cost to her of putting that money into a pension? If she's a basic rate taxpayer. Anyone? Yeah. So what would happen is that £50 otherwise would have been taxed at 20%, meaning that she would pay £10 tax on that income otherwise. So she would be left with £40. So she puts £50 in, but she's worse off by £40. So her out of pocket is £40, but £50 does go into a pension. So the cost to her to put £50 into a pension is £40 out of her net pay. And obviously, if she'd been a higher rate taxpayer, it would have been taxed at 40%, then it would have reduced her tax bill by £20, and she would have been worse off by £30. So if she's a high rate taxpayer, it would have cost £30 to put £50 into her occupational pension, and her tax bill will reduce by £20. Now, in terms of that, we wouldn't be looking for much more, really. I mean, that's probably ticking every single box with that. It's just knowing, and being able to explain the difference between how, I mean, the question could be, explain how a personal pension works, or gift aid, or give as you earn, like that. That's the sort of thing that you you do need to know the mechanics of. So personal pension and gift aid, we extend the basic rate band, and they also get the 20% tax credit going into their either personal pension pot or the charity claims it back at 20%. But because your pension provider or the charity doesn't know if you're a high rate taxpayer or not, you can extend your basic rate band to get the correct level of income. Or if you're an additional higher rate taxpayer, you'd extend the higher rate band as well by the gross amount. So that's the only sort of thing that could come up here is personal pension versus occupational pension kind of thing. And even then, it will not be a massive essay. Cool. Any questions on anything that we have done so far this evening? Cool. Right, so Wednesday night, it's me back again. We're going to be looking at the next 24 marks worth of tasks, which off the top of my head, yeah, we'll probably do 28 marks worth. So we've got, no, we'll do 24. So we've got national insurance, tax planning, and capital gains tax principles.